Hello and welcome to Oil Market Insight. We're here in Vienna on the occasion of the 157th OPEC conference. Now with me today just to have a look at what's been going on in the oil market, see the trends and see where we're going and have a look at the price and see what's impacting all that. Sean Evers is joining me, Managing Director and Managing Partner of the Gulf Intelligence. Thank you, Sean. Cornelia Meyer, the Chief Executive of MRL Corporation, and Jason Schenker, President of Prestige Economics. Now we were looking at the state of the oil markets, and indeed we haven't been here for a while. This is the very, very interesting thing. I haven't seen you for a while. Things have been rather stable for OPEC and for the oil market, and having a look at that, perhaps Jason, you can just kind of quickly look back over the year and their 50th anniversary year and sort of see where we are now with prices up there over $80 a barrel still.
Sure. Well, where we are now is very much where we had anticipated we would start the year, that the price of oil was going to be volatile between the $70 and $90 range with an average close to $80 for the year, and that's pretty much how it's played out. The dollars impacted things at times, first weighing on the price and now helping to push the price up with dollar weakness, and you had greater concerns about global growth, many of which seem not to be proving manifest at this point. Concerns about global credit also not proving manifest. Right now you have good expectations for global growth. This year IMF forecasting 4.8% globally. Next year 4.2% GDP growth globally. These things are all supportive of the prices of where we are now and higher prices moving forward. The story hasn't really changed this year. Despite all the discussion of double dips and all the discussion about high unemployment, most people will tell you or began the year thinking that the unemployment rate in the U.S. was going to remain very, very high for a very long period of time. Our forecast is for the unemployment rate to remain above 9.5%, not only through this year, but also through all of next year. The other thing is that despite that, I would definitely take issue with what Sean had said about quantitative easing, that, you know, at this point, for the Fed, they really can't do all that much. Even though they mentioned that this is one of the things they could do, go into the market and purchase securities, it's something that Ben Bernanke also said, that it's something they don't really know the long-term ramifications thereof.
But so the market is getting a bit nervous because of that right now, isn't it?
It's also building it into the price.
Yeah,
if they don't do it, the oil price is going to fall at this point.
That's correct. The dollar could rebound slightly in the short term, but basically the dollar fall that began many years ago, prior to the recession's bump up, has now continued to move lower. So maybe that recession period of dollar strength was just really a dead cat bounce. But in terms of weak growth in the U.S., just one quick point. This year's growth, based on IMF numbers, what the U.S. GDP, what everyone is referring to as weak, that growth, which would be 2.6%, would be about the same size as the 26th largest economy in the world of South Africa in absolute terms. You're adding a whole nother country ranked number 26 out of 220 plus countries in the world, even where we're having weak growth. So even though OECD growth is very strong, the level of U.S. growth, the level from which you're building on, is very, very strong.
Inventories are way above 5-year averages, as are products, gasoline, diesel, and so on. How much can those fundamentals continue to go against the oil price, if you like, and yet the oil price continues to sustain? I don't know.
Well, I think, Sean, what's going on is that the markets are pricing in also the future expectations. And unlike other financial markets, with commodities, especially with oil, you have a pretty liquid market, the ability to trade in the future. And people are going, well, global GDP is going to exceed pre-recession levels by the end of this year. And so even though Saudi and other places have spare capacity for oil, the fundamental story that we've all been talking about is global growth. Whether it's OECD is kind of slow and China and other emerging markets are very strong, there's very little way most of us could imagine the oil price going down on trend from here. It'd be very difficult to imagine a world in which the global economy and major economies suddenly fall off in terms of growth in a major way. So while growth will soon surpass pre-recession levels, during that interim period, there's been, I think, a pent-up demand that you're going to see going forward. I think you could very quickly move through and strip through this spare capacity. I think you could very quickly see us meeting here far more frequently than twice a year if the global economy really begins to pick up, which it's going to over the next year. And to back up exactly what Cornelia is talking about, I think it's less a question of does demand fall from here, does growth fall from here. This is, I think, a second derivative issue where growth is going up, but in some places it may go up at a slower pace. Even if we were to see growth slow somewhat in China or slow somewhat in the U.S., we're not talking about recession, we're not talking about growth coming off the table. We're talking about potentially seeing growth rates slow somewhat, but you're still looking at increased demand. And you're also going to see, especially in emerging markets, increased demand for things like oil. So while macro economies may see somewhat slower growth, a deceleration in growth, it's still up, and you're still likely to see increased energy demand.
But we're looking recently at the monthly oil market report where they've actually revised down the demand figures for next year as well. So in the short term, things are not looking great, but on a longer term,
I would certainly be of
the
view that there is another surprise of this down cycle. I don't know what it is. We're now talking about currency wars. The media's jumping all over that. They'll make it happen if it doesn't happen.
Sovereign debt. I think sovereign debt's the potential big question mark. Greece and the other pigs have been, we've seen them. We've taken a peek in a Pandora's box. We may have closed very quickly. But things like growing, mounting U.S. sovereign debt needs, the talk of more fiscal spending in the U.S., other countries that continue to spend and spend and spend. How much more can all of these different economies continue to bear the burden of spending money they don't have and financing the spending of money they don't have in a market where the value of credit and what the real risks are completely unknowable. And I think if there's an unknown unknown, or if there's a known unknown, it's probably somewhere in that sovereign debt mix.
I would agree.
But you look at the state of some countries, and the banks are back in the public sector. So a lot of that, is something where the financing is coming from. So that has to shift. So in all, we're really looking at, maybe we've had to pull back, really sort of viciously at this level. But where's the step then that we can go out, and where do we look in the future to move this market? Because that's what we have to be looking at.
Well, I think that's a good question, and I think right now that tied to this is the issue of getting credit. So a number of our corporate clients, they tell us that the money's out there. Everybody knows the money's out there. Individuals and companies know the money's out there. The Fed and other central banks, very low rates. The money is out there. Getting approved to get the money and passing through the new risk management sort of scheme of things and getting through that gauntlet is a tougher question. And so making sure that the credit gets to the right people is probably better. But what you have right now is a lot of people doing what they did to Japan at one point, where they borrow at very low interest or no interest effectively, and then they put their money elsewhere, but at some point they may need to unwind these unusual carry trades, which can affect both the credit markets and the currency markets.
I'm afraid we have to wrap it up there. I want to thank you all very much. Jason Schenker, thank you so much. Cornelia Meyer, thank you. And to Sean Evers, my guest today at this Oil Market Insight on the 157th OPEC conference. Thanks so much.